Today is Monday, November 24th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, Mark Bowman, and JP Snyder, all members of the ADMIS Research Team. And starting with the grain markets this morning, Mark, what will drive prices across the agricultural markets this week?
Yeah, well, we're starting to finally get some of the delayed usage and CFTC data from the 6-week government shutdown. I don't think that this information will carry a lot of weight in the price discovery process, as we are looking back in the rearview mirror quite a distance. So to me, the markets will just continue to be very sensitive to any evidence of additional Chinese purchases of U.S. beans. Prices did surge up to a 17-month high early last week on reports that China bought up to 2 to 3 million metric tons of U.S. soybeans. It's still a pretty smaller fraction of the 12 million metric tons the Trump administration has been touting that China has agreed to purchase since late in October. This morning, the USDA did announce another 123,000 tons in sales, which brings the announced sales so far to just over 1.9 million metric tons. But with spot offers in Brazil slightly below that here of the U.S., I think it's tough to envision large Chinese purchases moving forward, particularly given the fact that it sounds like they have been washing out of some previously announced purchases from Argentina late last week to make room for the U.S. purchases. And you look at that price differential between the U.S. and Brazil, that only just gets wider here as we get into next year. It's out to almost $1 by the time we get to February, so we get a little bit deeper into that Brazilian harvest, and that's even before you factor in the 10% tariff differential that works against U.S. beans. Which brings us to our next factor that I think will drive prices, and that's South American weather. Right now, conditions are largely favorable. Good rains are expected across much of the central and northern portions of Brazil, really looking out the next week to 10 days. And if moisture kind of lays out the way it's forecast, I think it could go a long way at filling in some of these dry pockets that have popped up here in this region. And in Argentina, heavy rains here in the middle part of November did lead to isolated flooding, primarily across east central province of Buenos Aires. Much needed drying this week, with the next chance for moisture coming this coming weekend. And really right now, still no evidence of a deepening La Nina situation, which is often lead to hot, dry conditions in Argentina.
Yeah, Mark, you're talking about the soybeans. Do you think that maybe, or do you sense that prices maybe have peaked?
I think they have, Kurt. Spot jeans, hit a high last week. I mentioned a 17-month high at about 11.70. That's a $1.70 off the lows we saw back in August. I think the CFTC data will eventually show speculators went from net short around 65,000 contracts in August to a peak probably earlier this month at just over 100,000 contracts. And that would be their biggest long position in 2.5 years. Well, the recent Chinese buying has certainly been welcome news. I don't think that it has been enough or will be enough for the USDA to keep their export forecast above 1.6 billion bushels. We're using more and more beans domestically, as the recent crush data has showed record amounts of beans being crushed here in the month of October, well above expectations. So I think you're going to see a little bit of shifting into crush and away from the export side of things. But if conditions in South America remain favorable, which is a big if, and it looks like combined Brazil and Argentine production exceeds 225 million metric tons, and yeah, I think beans are going to work their way lower here in the year. And there's a gap here on the charts between 1063 and 1070 on the January contract. I think the market's going to make an attempt to go back and fill.
Thank you. JP, expectations have shifted regarding Fed rate cuts. Why?
We've seen some steep swings in Fed rate cut probability for December's meeting just over the past 2 months. Just over a month ago, we were nearly fully priced in for December rate cut. But as the shutdown hung over investors' heads and really just a mix of private data, that had sort of led markets to trim bets on chances of a December rate cut. Additionally, we saw a lot of cautious comments from several Fed officials, and a release of October's meeting minutes led markets to further trim bets on a rate cut, sending odds to as low as nearly 30% during trading last week. The meeting minutes highlighted a really divided Fed, and consequently, that would make it hard for markets to determine what the Fed is going to be doing come December. Now, that all changed Friday. New York Fed President John Williams said that another rate cut in the near term could be warranted, in an effort to bring rates closer to neutral. What's notable about his comments is that he is an ally of Fed Chair Powell. So markets took his comments as a signal that Powell could potentially be coming into this meeting with more of a dovish tilt. He is likely to be the deciding vote at December's meeting, as recent Fed speak has been mixed, and as odds of a December cut have really just been seen as a toss-up over the last couple of weeks. The December meeting is set to be one of the most unusual in years. Not only are officials divided over how to manage the risks of weaker job growth and rising inflation, but they have also been operating without data that often helps them calibrate their forecasts in ways that can help reconcile any disagreements they have within the Fed. So with the lack of data and stronger disagreements across the board, markets were really up in arms about what to do. Now, Williams' comments did help bring some of those chances higher, but really just a strong boost for rate cut odds all in all. September's jobs report also did not help offer too much guidance for Fed officials regarding clarity on the labor market. The better than expected headline growth was met with an uptick in the unemployment rate. So as an ally of Powell and a considerable voice on the Fed, Williams' comments helped lift market sentiment and as a consequence, bring up odds of a December cut.
Thanks, JP. And now that the government is open, what data releases are scheduled for this week?
Yeah, so we've got quite a few data releases this week, including some delayed releases that are playing catch up with markets. I would say the key releases are going to be September retail sales and food services data Tuesday, as well as September durable goods orders data on Wednesday. Both of those were delayed by the government shutdown and were actually initially due in October. Now, these releases won't be as coveted as September's labor report was. However, they will be a telling signal on how consumers were holding up as tariffs had started to settle into the economy. The Bureau of Economic Analysis also had two rescheduled releases, originally due to be published this week after the shutdown. Those would have been the second estimate of third quarter GDP. That was originally scheduled for Wednesday, but will now be delayed until a later date. It will also delay October data on personal income and spending, also originally scheduled for release Wednesday. Now, moving on to Wednesday, what will be released will be weekly jobless claims data, and that is set to take on more importance after the BLS announced that it won't publish the full October non-farm payrolls report, and the November report won't be released until December 16th. That's 6 days after the Fed's meeting, so any data on the labor market in between here and the Fed's meeting likely to be very looked after. We'll also get the Fed's beige book, and that more or less just a summary of current economic conditions. Other data that we'll get this week will be producer prices, pending home sales, as well as the Conference Board's consumer confidence and Case-Shiller home price index on Tuesday. Nothing new through Thursday, obviously, thanks to the Thanksgiving holiday. But on the Treasury front, we'll see a $69 billion auction in 2-year notes on Monday, $70 billion in 5-year notes tomorrow, and $44 billion in 7-year notes on Wednesday. So in a shortened week of trading, these releases are likely to catch attention, more so the retail sales and PPI figures. They also could garner a stronger reaction than normal due to the thinner trading, but I don't think their impact will have too much of a say on markets as attention fully remains focused on the Fed.
Thanks, JP. Mark Bowman, now that President Trump has removed the 50% tariffs in the Brazilian coffee markets or coffee imports, what's next for that market?
So, first of all, removing the tariff does open up supplies from Brazil, which up till this year was the biggest supplier of U.S. coffee. They represent about 30% of U.S. consumption. This may ease prices in the short term. Market did break sharply off the news, but it doesn't necessarily fix a tight global supply situation. Back in June, USDA was putting the stocks-to-use ratio for 25-26 at 12.85%, which was the second lowest on record, and also below 15% for the third year straight. Those are just low numbers. Since then, we've seen a lowering in Brazilian production estimates. In September, CONAB lowered its Brazil Arabica forecast to 35.2 million bags from 37 million in their May estimate. The USDA number was from June, right? And Saffron Mercado also in September lowered their number to 38.05 from 40.46 in May. So if you take 2 million bags off world-ending stocks, all other things left equal, it would put the global stocks usage down at 11.7%, which is a new low. In the short term, we've started seeing improvement in the direction of ICE exchange stocks. They still dropped last week, but they were up 3,400 bags on Friday. They increased 2 of the 5 days last week for really a net decline of the week of only 1,100 bags. And this is the first time since September there were 2 or more days in which stocks increased during 1 week. So maybe an indication that we're starting to see recovery there. The upcoming crop for Brazil, 26-27, does look more promising. This will be the on year for their biennial crop cycle. And so far, the key growing regions appear to be getting good rains after a slow start. There will be a lot riding on a strong crop, and the harvest for that is still 6 months away or more.
Lastly, Mark, what do you think is the crucial factor for the energy markets this week?
Well, the big question is, will there be peace in Ukraine? The market did sell off on Friday after President Trump offered a plan to the Ukrainian president and told him he had till this Thursday to accept the offer. Now, this plan requires, among other things, Ukraine ceding territory to Russia. And there was not really a lot in it for Ukraine to like up front, but there were some safety guarantees, and the Ukrainian president may feel he has his back to the wall in this case. And the chances for an agreement seem to be inching away from highly unlikely to possible. Over the weekend, Secretary of State Rubio suggested there could be some flexibility on the deadline if some progress is made. They also announced some progress as well. Talks are continuing today. They had a joint statement on Sunday that they had drafted a refined framework after the first day of talks. Now, some EU countries put forth a counter proposal. It's a little more favorable to Ukraine. But so what would it mean? Peace would mean an end to the Russian sanctions and a freer flow of Russian oil to the global market. This may encourage OPEC to tighten again, but then again, the Saudis have the desire to gain market share, and they're not really happy with scofflaw, so they might want to keep the oil free flowing. And another factor is on the products. Russian refinery activity and exports have been curtailed after the Ukraine drone strikes, as well as sanctions not only by the U.S. and the EU. And if the sanctions are lifted, we might see more Russian oil products flow into Europe, and that would ease a tight supply situation in distillates especially, but also perhaps Europe may want to be interested in buying natural gas again.
Thank you all. Remember, the views and opinions expressed today in this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.